Gaps are a commonly seen occurrence within technical analysis, and essentially it means that you get a major jump in terms of price, often when you see a difference between the closing price of an asset and the opening price of an asset. Now within IG, one of the real strengths of IG is that you can trade outside of market hours. However, this means that you often don't actually see the gaps. And within Pro Real Time, you actually, under the options tab, can choose to only see the price action within the trading hours of the asset that you're actually trading. And therefore you can really see those gaps and really make some judgment calls on the back of that. In terms of the types of gaps that you can see, there's the common gap, which, as the name suggests, is most commonly seen. It doesn't necessarily give you too much guidance. Often people will expect that gap to be closed and will see the entrance to that gap, so the initial point at which the gap is opened, they will see that as a likely point for price to return to, for it to then continue to trend. So it can be providing support. Now, common gaps largely do get closed. However, there are three different types of gaps that often do not get closed and really can signal something about the market as to whether we're at the beginning, the middle or the end of a trend. Looking at the FTSE 100, we've got these three types of gaps showing on the hourly chart throughout August. Now the first of these is the breakaway gap. It comes after a period of consolidation where the gap either jumps through support or through resistance to then move into a trending market. On this occasion, we've got support around about 66.50. The price jumps through that, the gap isn't closed, and we move into a downward trend, and that is all starting from the breakaway gap. The second type of gap is the runaway gap. It happens within the trend. It's when everyone feels like the market's moving in one direction, and you get that jump without that gap being closed, and it then continues to trend in the direction of the trend. And the final one is the exhaustion gap. Now this is often confused with the runaway gap because on first glance it looks very similar. However, the big difference is that this actually gets closed by subsequent price action and signals to the market that possibly the trend could be over for that asset.